All right. Good morning, everybody. TGIF. The president is cracking his thumbnails this morning, doing some tweets on Truth Social. I guess that's what it's called. I don't know what they call it. I don't have a Truth Social account. Maybe they call it truthing. I'm not tweeting. Whatever the heck it is you call it, he's doing it. Messaging that 80% sounds good. He had made comments yesterday that 60% sounds good. So the market didn't like hearing 80 after they heard 60. So now we got some shenanigans, a little bit of whiplash, but once things settle out for a bit, the big takeaway on the week is that we were holding within Friday's range. That the expectation we had on Monday, Tuesday, and part of Wednesday was that we would hold the line, really not go anywhere, and that if we left the range, we would very likely come back inside the range. And then for FOMC, it was let's get there and see. Who knows, right? OMC, they basically said no change, same old, and we're still within the range. So we're waiting on something else. When we look out at what is next, we have FOMC out of the way. We have next. That would be on the 16th at the same time that we get the tick data, which would potentially be the next area of drama, right? So it does show that we've got a little green here, but it's fading fast. NASDAQ at 25%, S&P below that, and then the Dow, and then small caps basically flat. We got a lot of Fed speakers today. And when we first started to drop, I thought it was one of the Fed speakers because it was this one guy that was already talking, right? What's his Krugler. Krugler was already chipping teeth, so kind of figured it was him that dumped the market, and then then that came out. So we knew it wasn't him. But throughout the day today, we're going to continue to get these different Fed governors chipping teeth, having some input. It's possible that they get taken out of context, that they say something they didn't mean to say, or their words get twisted around. It's always a threat or a risk. So want to pay particular attention when they're talking. If you notice, the last one is around 11:30. So maybe the later part of the day today will not have a lot of stuff going on, and we'll have a quiet afternoon. We got the rig count. I used to work on those rigs. That number does not change much, and we're not expecting any drama there. If we did get some drastic, radical change to that number, sure, we could see a potential market disruption, but it's such a long shot to see something like that that there's just no expectation, right? So that leaves us with an afternoon that may be free and clear of all these shenanigans, and we could if we don't get any surprise reactionary weekend news or end of the week data dumps as they used to do, then we could have a Friday afternoon of one or two possibilities: that we go really quietly sideways into the weekend, or that we finally break this range and really run without even giving any directional bias of which direction it would be, up or down, just that we finally get out of the range. This is from the tweet. So it didn't even give us a good liquidity candle, right? Like a good liquidity gap. It did give us something to measure though. So you'll want to measure the top and the bottom of this range, plot the midpoint. You could focus on the open of it as well. not really the close all that much, but I would hit the high and the low and then the mid and see what we do with it from there. If we hold the line within that, which would be a very boring Friday, but we could absolutely do it. We could just stay right inside that range. Whoa, that would be a boring Friday. It would look a lot like what we had in the Globex once we settled into this zone, right? Just something like that. We don't want it, but that's what we could get. All right, 50% on either side of that level. And of course, you got the 1, 2, 3, 6 on each side. So if we begin to break out to the downside, the 1, 2, 3, 6 lines up with our own Globex low. The 50% looks like it lines up with yesterday's high or close to it. Now it comes up a little shy. So it doesn't quite get us there, but we do have 111 and 1, 2, 3, 6 in each direction. Once we get to the low here, we could expand at this drawing to the downside. We have yesterday's low and then on down from there, right? If we look at the daily, which is what I have here on the right, this is Friday's price action. Friday's high and low. A couple other areas of interest, 56.92. It was a high, it was a mid, it was a close. It's also a cog line. So a lot of structure there. Otherwise, we got a midpoint around 56.65. Got this low to deal with from yesterday. And that Friday low that we've been working on, it's at 5,600. It's a long ways off, right? And we're sitting at 56.85. So if it is a downside move, we got 85 points just to get there, but we have anything else going on. For an upside move, you know, we got out of Friday's range once already, and we weren't able to keep it. 57.50 is what they were front running up here, right? We didn't even get to the 57.50. So we would have to challenge that high of yesterday again, give it another shot, and we've got 57.52 as the ADR half. So ADR, average daily range, how far we could move on a day-to-day, just an average daily move, says that we can go to 57.52 by the end of the day, right? So it's within our reach easily, absolutely. We need to get out of this box, whether we do it today or we do it some point next week. That's what we got to do, right? We got to get out of this box. Now, we got some reasons to believe it might be next week. We have this meeting with China and Switzerland, and the headlines kind of portray it as a meeting on tariffs, and it's really not. It's a meeting on de-escalation. They're not even going to be talking about tariffs in this meeting. So on Monday, when we come in and everybody finds out that they didn't even discuss tariffs at all, that they only discussed de-escalation, the markets might respond in a negative way to that. Of course, we could have other positive news that offsets it, like the deal with Europe that seems to be going through. And then, you know, that can change the dynamic a little bit. But otherwise, going into the weekend, holding this range makes perfect sense. That we don't sell off on some market fit of rage after making it through what we've already been through this week. So GTFO, get out of this range. Simple enough. Looking at 80,000 on the overnight. This whole week has been more normalized on the volume, and it's kind of nice to be back to where we used to be, right? Getting out of those 150 and 200 ranges that we were holding for quite a while. So we'll see if this new normal sticks or if we start getting elevated again. I would think that as long as we don't start breaking down into 5,400, 5,300, then we shouldn't see those elevated levels again. We are still above the zero gamma and volatility trigger. 5820 on the call wall, 5387 on the put wall. That's a new number. See what it was yesterday. ES put wall, 5220 is what it was yesterday. So they rolled up the put wall. And generally speaking, that's a bit of a bearish behavior, right? Well, that's not the put wall. Never mind. That's just one of the levels, right? What is that one? 5387. Combo 2. Yeah, that's not helpful. So no change in the put wall, 5220. It's actually combo 4. Yeah. Nope, not useful. So we're still above the 10-week, the 10-day, the 3-day, 20-day. We're above all the major moving averages, but we are continuing to test that 3-day. You can see it as the white line here. We were cutting through it on Tuesday, again on Wednesday. And Thursday, we bounced off of it. We cut through it on Friday. We're back above it. That's the line in the sand that we want to see hold, right? It's a very short duration, short-term moving average. It's really close up, but it would be a part of the surge signal if we were to cut under it. So here's the daily again. You can see the 10, 20, and 3 forming this fork shape, and they're uniform in their distance. They're all pointed in the same direction, very clean, organized. We're looking for this crossover event only to the other side, right? If we're already up and we're looking for a crossover, then we're looking for a downside cross. The idea would be that price crosses first, gets through the white line, the blue line, and then drags the white line through the blue line, which like we did here, right? So price made the jump first, dragged the white line with it, the white crossed the blue. It's surge signal. We had an upside surge, and then we held above that 3-period moving average for the run up. Now we've stalled and we're chopping and we're just going back and forth through that zone. Breaking the low of Friday would put us under the 10 and begin that expansion to the downside. Or it would give us a chance to reset like we did here when we cut through the 4 and the 10 and bounced off of the 10 and the 20 and went right back up again. We're still looking, I'm still looking for this deeper, higher low, because this is a higher low, but it didn't give us very much, and I kind of feel cheated. I think we should have gotten something a little deeper. So watch that 4-period or 3-period moving average. It's at 5674 and a half. Today's floor pivot is really narrow. It's not as narrow as yesterday's, but it's still pretty narrow. A narrow channel implies that if we break out, it could stick. And we had that yesterday, right? We had a breakout of Wednesday's range, made a nice run of it. We held that breakout all the way into the close. And then right into the close, we got back inside of Wednesday's range. But idea still holds. Today's floor pivot is kind of the same thing. It's really narrow channel. It implies that if we break out, the breakout could stick, that it could grow legs and we could really run. But we're kind of near the midpoint of yesterday, right? So to break out, we would have to run all the way up to 54.70, break yesterday's high and continue to run, or run all the way down, break yesterday's lowest low, 56.42, and then continue to expand to the downside. For a downside move, that would put us back into contact with the weekly pivot point. And now that we've expanded far enough away from the weekly this week, going back to it, it should act supportive. When we were just chopping in the zone, then we can go through it as much as we want. It's not expected to be support or resistance, but we left the range. So we would expect that now. Keep coming back to the idea of why would we break out and run today, right? Higher or lower. And since we don't have any economics on the table today that could do that, it would have to be shock and awe headline news that comes in that we didn't see coming. That would be the only thing that I can think of that would galvanize us into such a breakout today. 56.44 is this week's point of control. If we break that, we'll target the low 5600, and below that we've got 55.50. To the upside, we're back through 5700, so we've got 57.32, which is a high value, high volume node, and then through the top on the week and into new highs on the week. But on what fuel, right? What would galvanize us to do either one of those today? And that's kind of the hang up. Now, 0-day flows could do it. Absolutely, right? The dealers, they could come in and they could move the markets based on their hedging flows, but we're so close to zero gamma and volatility trigger that it's not like we're deep in the hole in a really negative gamma or really far above in a positive gamma. We're just really close to the line. Doesn't seem to be any reason for them to step out of bounds. So that kind of takes away any excuse for a 0-day flash push too. 10-day, 30-minute volume profile with TPO, they're almost lined up again. We still have days, nearly a week before we get to the candles that made this point of control. So the only way this point of control is going to move sooner than that is if we build out a new structure. 5700 is building out really nice, and if we stay in this zone all day today, it's possible that by Monday we could have a new point of control, that we could bring it up into this zone. Otherwise, if we do break our point of control and get below it, that 55.50 area can be built out, and we could build it out before we get to these candles. But that's what it's going to take, right? We got to get a new level built before we get into these candles here. So as time goes by, these candles are going to slowly get wiped off the board, and we'll be here. We need to either have one of these built where we're at here at 57 or down here at that 55.50. It would be better for the market if we stay above the point of control that we have, right? We don't want to break below that and put in another one lower down. All right, we got a new VPOC from yesterday. So now we're pinched between two of these. $57.26 on the upside, $56.32 on the downside, almost 100 points apart. This will make it more difficult to get through yesterday's high, because we'll have to get through that VPOC first. I'm not saying it's impossible or that we can't do it, just that that's one more thing that we would have to fight through to be able to do it. And we've been struggling with that 5,700 since I started the stream, right? Just fighting it right now, building out a high volume node here. It's very likely that if we expand away from 57 again, that we're not able to get back through it today, or at least until maybe after the open or after lunch, right? Different checkpoints on the day. One 1.4% above the 10-week. Things are still fine here. We're not overbought. We're not overextended. We haven't moved too far too fast. And we're not close enough to the 10 to be stuck in a gravity. So everything's fine from that perspective. We are on the way back. So after having expanded into like 2%, just kind of drifting, giving the 10 time to come to us. Call that a correction in time rather than a correction in price. Looking at the 10-day, we're still holding around 1.3, previous level like 1.4. So we're pulling back just a bit after having come up some. Didn't see a reset back to 10, didn't get below it on this run. But overall, if we look at where we were, we are on the way back. We can see where we get these drops, and then we start to work up a bit and another drop, much like the market, right? Everything runs in those waves. So this is kind of choppy, doesn't really look much like a wave, but still it's the same idea. It's a wave. So a little bit of a wave to the upside wouldn't be much of a surprise if the wave ends and we get closer to the 10 again. But that doesn't necessarily mean that we would go down. We can sit where we are and the 10 can come to us. Which is another reason to think that we might just hold the line and stay within the range today. If we break Friday's high, it opens the door for us to go to the end of the week's expected move. It's 58.26 today, no less, right? We can easily do it. We've done it before. So we're talking about, 125, 130 points. No problem for the ES. The idea would be why? What could get us to trigger such a move on a Friday, right before the weekend? Nobody wants to accept more risk in the current climate right before the weekend. We do have next week's range on the table. Now, this range is not set in stone yet. If you look back at all these previous weeks, I'm kind of zoomed in so they don't show up much, but every week we've got one of these ranges, and these previous ranges are all locked. They won't move anymore. This one is alive right now. It's still moving. It's expanding, contracting. The gray line is price, and it's moving up and down. So this whole thing is going to continue to shift through the day, and after the close, it will lock into place. But we can use it as a bit of a preview, get some clues as to what the market is expecting for next week. If the range is wider or narrower, then it gives us some ideas about the volatility being priced in or unwound in the market. This is the range that we had this week, and we can see that the box that I drew is a little smaller. So next week's range is a little more narrow than this week's current range. At first glance, that makes us believe, hey, lower volatility, that's great. There must not be any really big threats or big events. Unfortunately, that's not exactly true. Big events are volatility suppressing until they happen. And we have OPEX next week. So if OPEX is seen as a big threat or risk, then the markets will go sideways into that risk because, again, why would anybody want to pile in with a bunch of money and try to, front run that risk? So it is narrower for next week. If it's not the OPEX, then what's the threat? And that's something to really consider over the weekend. What's the market pricing in that's so scary? It's bigger than FOMC's risk and non-farm payrolls. Or it wasn't non-farm payrolls this week. It was just unemployment numbers. Still, it was employment numbers. We had a lot of data this week. Next week's range is even more narrow than this week's. That does also imply another week of sideways. Now, sideways, low volume, it's a recipe for a big move. And that's usually how it ends up going, right? That we get a week or so of sideways like this, where we just don't do nothing for a whole week. Consider that a draw. So we're sideways, we're drawing everybody in. That's why it's called a draw. Longs can get in, shorts can get in. Nobody knows if they're wrong as long as we stay in the box. Once we break the box, well, now you know you're wrong. Then we raid liquidity and we make the move. That's the play, right? That's why we call it a raid and a draw, or a draw and a raid. It could have gone the other way around. We could have dumped down first, raided the liquidity here, and then made the move to the upside. It didn't have to be only a downward move. So we've got the range built. We are developing a draw. Longs and shorts can be building out their positions here, more and more and more positions. Just kind of think how that winds up, right? Just more and more and more, like a coiled spring. And where do their stops go on either side, right? If you're long, your stops are down here. You're short, your stops are up there. Just building it out more and more and more and more. Sooner or later, this thing is going to break, very likely get a raid and a run. The range for next week implies more sideways. But it's going to break at some point. And the more sideways implies that the market's worried about something. Just like they were worried about FOMC this week and we were sideways into the FOMC. Not much is down this morning. And we don't really have a lot that's up either. We're using the benchmark of 0.5%, and most of the things that we would look at are not down more than a half, and they're not up more than a half. So most of the market is in that wishy-washy middle ground, just not moving enough on either side. The things that are up, we got China, so emerging market, that's basically China. Chips, gold miners, generic energy, Bitcoin, more Bitcoin, nat gas, which whatever, and XXX semiconductors. But we already had semis, so it's just another take on risk for semis. Bitcoin is risk, seeing it up. They are happy to accept more risk. We got risk appetite, which is a good thing. Implies that we got money coming in. People are willing to trade the Mag 7, get more push or flow to the upside. But this is not bringing everything with it the way we'd expect it to. XLF, the financials, one of those that we need. Think of it from this point of view. These top three are the risk-on sectors. If we're in a bullish market day, we would expect names from these sectors to be doing good. And we'd expect those sectors to do good. Now, we don't technically need finance in this scenario, but it is one of the three. So as long as it's not going down, then tech and consumer discretionary can run things. If that was falling, then these two would have a hard time rising. And if they're all rising, then it's just everything to the upside. We don't really have those today. We don't see much of the Mag 7 in that list so far. And when we say tech, well, that's really generic, because it could be cloud computing, chips, art tech, old software, old hardware. A lot of things that are, quote, tech. And all we've got is SMH, just the chips. So we need more than that. At any point today, we could trigger more of that. And that's all it would take, right? Is that we would get, say, the Mag 7 to break out and run, or we can get just this rising tide of all boats moving to the upside. But we can't get a breakout rally day on pot stocks. That's just not going to do it. So we need more. Mags is getting a little bit of flow. That is the Mag 7. They're at 61. So we're getting a little bit of bid in those. It's a good start. That with chips and Bitcoin, that's a good start. We would want to see this turn into a rising tide, though, and bring everybody else along with it. And if we have anything that's going against the grain, that can really hold things back. %20 of the NASDAQ, 27% of the NASDAQ is down, is up 0.5%. That's not overly bullish. 27%. It's not much. 20% of the S&P is up 0.5%. We want to see those numbers change drastically, right? Got 100 names in the S&P 100. You'd want at least 50% moving to the upside or more, and having made at least 0.5% move. And then what names? If it's utilities and retail, that's not going to break us out and get us to run in the S&P and the NASDAQ. Got to be Mag 7 names or big tech influence names, right? Hyperscalers. Texas Instruments ain't going to do it. So we're lined out pretty good at this point. That big candle that we got on the tweet this morning has now defined the trade box. Get out of that box, and you've got to play to the edge. Doesn't matter what direction, right? Just get out of that box and you have a play to the edge. If we break out of the top, target yesterday's high. We break out of the bottom, be a little concerned with this Globex low, but otherwise target yesterday's low. That's some pretty good money just right there. That can get you into the weekend, make a mortgage payment. Beyond yesterday's low, then target the next day's low and just on from there, right? We don't even need to break out things like the 111, 1, 2, 3, 6. Those would just be stopping points on the way down, places where we expect a pullback, right? Another leg lower after digestion and consolidation and push again. It's a really nice gift that we have here. If we don't get out of that range, then you don't have to worry about a trade, right? You can just stay out and avoid the chop, and you don't end up, trying to trade something that maybe looks like that. Unless you like that kind of stuff, then by all means, aim at it. That's what I got for you guys. Be careful, be safe, watch the headlines. I will see you all next week.